We're talking all things gold and macroeconomics with Peter Grosskopf, CEO of Sprott Inc. today. Peter, it's the first time you and I have spoken. You've been on Kitco several times, but this is the first time I've had the pleasure of speaking with you directly. Thank you for being here.
Well, delighted to be here, and thanks for speaking to me.
You are an expert in all things to do with the resource sector. We're going to be talking about some of your stock selection processes and what Sprott is doing. But currently, I like to talk about the gold price as it currently stands. And as you know, we've had a significant decline from its August highs in 2020. What's your outlook now? What's your sentiment? Let's start with that, and we'll continue the conversation from there.
Well, I think it's a pretty good time for gold investors now to be adding to their positions. As you mentioned, gold has had a pullback, and in fact, on our sentiment indicators, it's been one of the weakest assets out there in the last 2-3 months. So whenever you get the herd moving in one direction, I think contrarian investors get a good buying opportunity. On the other hand, nothing has changed fundamentally. If you look at the world's issues, the financial assets of the markets have gotten more and more extended in terms of valuation, but the underlying issues have not gone away. We have a massive and building debt problem in both the corporate and the government sectors. And I don't think we have enough underlying economic growth to support that debt absent lots of accommodation. So you've still got this environment of fiscal repression, and that should be good for gold in the long run.
As we're speaking today on the 12th of April, the U.S. budget gap has just hit a record of $1.7 trillion for the first half of the year on the back of new rounds of stimulus. I don't think it's ever been this big so quickly into the year. So you are right, we do have a deficit issue or problem, however you like to word it. I wonder how this translates to the gold price. How does it relate to the gold sector? Why does gold benefit from large deficits or overspending from the government?
Well, right now it's kind of like the Alfred Newman caricature on Mad Magazine. You know, what me worry? Nobody's that focused on the deficit. They're more worried about the state of the economic recovery after COVID. But it will matter at some point. Fundamentals always matter in the long run. And yeah, I mean, the deficit is kind of playing catch me if you can. It just keeps going up. And that's no different in the U.S. than it is every country in the world. Governments are running massive budget deficits, and they don't seem to have a way to tax their way out of their issues. So even though they might increase taxes, it's not going to be enough. So the debts will continue to build.
Mm-hmm. And when debts build, which variables in the economy will be moved significantly that will impact the gold price?
Well, then you get this question of where are rates versus the gold price, where is the US dollar versus the gold price, and where are monetary aggregates, deficits, et cetera, versus the gold price. And I think the equation that we can all agree will be good for gold is higher rates times bigger debts does not make for a good mathematical equation. It's going to be more difficult to sustain those debts going forward. And you know, where gold comes in isn't as an alternative to financial assets, store of value. If something were to happen to financial markets, corrections, tail risk, gold usually performs extremely well in those circumstances.
Okay. And to your knowledge, what has been one of the biggest factors behind gold's decline from August highs?
Well, undoubtedly, it's been rates. It's been a little bit of dollar, and probably a bit of cryptocurrency investing stealing from the flows of gold. But I think rates by far is the biggest factor on gold in the last 3 months. And that was unexpected. And that's why gold got hit particularly hard. And it was also, a hot trade last year. So a lot of the hot money came out of it. And this is something we see with gold again and again.
Yeah. Now, let's talk about rates for a second here. I've heard different theories as to why rates went up. Some say it was because of higher inflation expectations. Some say it was because of improvements in the economy and expectations for an improving economy. Some say they were just too low for too long. They had to have gone up. It was only a matter of time before technical improvement happens on the rates front. What do you think?
I think you've summarized it really well, all three factors. So a bit washed out at the bottom there. And secondly, we were seeing some noticeable improvement in the economy, and especially in the U.S. as the vaccines took hold. And thirdly, inflation expectations have been jawboned up here by most governments, and also seeing some real commodity movement there, which support that in the short term. We'll see what happens in the long term.
Here's an argument against gold, Peter, and if you could comment on this, that'd be great. Rates are still, historically speaking, pretty low. The 10-year yield of 1.6, 1.7. Yes, it's gone up significantly since 0.5%. Just a couple months ago, but it's still historically quite low. We've got a lot of room to climb, experts say. Now, if that is the case, would that not be a bearish case for gold? Because if rates are only headed up from here, why would you place your bets on an asset that is inversely related to rates?
Well, I think you have to take it the big picture as a whole. So if the debt levels outstanding on the government side were not as large as they were, you might be right. But with 20 trillion in U.S. debt and counting, and building at the rate of 2 to 3 to 4 trillion a year, you just can't have rates going up without a massive need for support by the government and the bond market, and massive need for more budget deficits to essentially afford the debt load, the interest burden.
Does Sprott make projections on the gold price, forecasts like the banks do?
We do, and as a team, I think it depends on whether you're dealing with our fundamental strategists or our technical strategists, but generally speaking, we're forecasting a return to the highs over the next 6 to 12 months.
Mm-hmm. Okay. And before gold returns to these highs, what needs to shift in the economy? Does there need to be any change at all, or are we currently on the right track and hit there eventually?
Well, I think one of a few things needs to happen. Either you get a correction in financial markets, which is becoming more and more possible, I think, given how extended they're getting. Secondly, you might get a major correction in rates that they've overshot now and are coming back down again. And thirdly, you might get disappointment on the economic side, just because the rollouts of economic growth, given COVID and given other difficulties, are taking longer to conspire.
Okay. So rates, economic improvement not being great, and also a financial markets crash. I've noticed inflation picking up is not on your list of criteria. Is there a reason you left that out?
Well, I think inflation is there for the long run. You just look at the depreciation of monetary fiat currencies over time. I don't think they count it very well, but runaway inflation is not something that I would bet on at this time. It's just that once it takes hold, it could be, year after year, you've got a decent inflation rate. I think more than that, you've got real rates, which will remain close to zero, because you do have some inflation out there now.
It's interesting. I've talked to several people in this resource sector. The overwhelming consensus is that with the increase of the money supply, especially the increase in the Federal Reserve's balance sheet that we've seen in the past year to unprecedented levels, inflation by definition has to come. You actually take the side that Federal Reserve Jerome Powell has said, which is that inflation is probably not going to be a persistent long-term force. So your views resonate more, I believe, with what the Federal Reserve has officially put out as a statement. So I wonder why you don't think that the increase of the money supply to levels we've never seen before is necessarily going to lead to higher prices, sustained higher prices.
Well, I still think the economy and the financial system have the slack in the labor markets, the fact that a lot of people are unemployed or choose to be unemployed now. There's a lot of slack out there. It might take quite a while, but I'm not actually agreeing with Powell on this. I do think inflation will be persistent. I just don't think it will be endemic over the next year or two. I think it will start to take hold, and once we have it, it'll be impossible to get rid of. And I think that in contrast, interest rates will stay low, so you'll have real rates in that close to zero category for the foreseeable future. I mean, that itself is the definition of financial repression, and that's the only way they can make the mathematical equation that they have right now work.
Yeah. Have you ever seen this kind of financial repression in your career? I mean, you've worked in this field for a long time and you've seen many cycles of gold and other metals. Is this something you've seen before?
I've never seen central banks so backed into a corner as I do now. I think they're really, although they still appear to be in full control and there's still a lot of confidence in central banks, I just do not think they have a lot of room to maneuver. And if anything unexpected happens from here, there could be big trouble.
And where is the U.S. dollar headed in light of all this?
Well, I think the best expression is it's the strongest horse on its way to the glue factory. I don't see other currencies rallying against the U.S. dollar. So by definition, it could be holding its own here at a minimum. But I do think that the U.S. is committed to its easy money policies, and I don't see it getting a lot stronger. I do see fiat currencies losing their purchasing power much more rapidly than inflation indicators would indicate. You just look at what they've done against the housing. I mean, housing as other financial assets are rallying. Crypto, a lot of things are rallying by large percentages against fiat currencies now.
Speaking of currencies, we're going to be talking about central bank digital currencies now. Several central banks have indicated interest in either experimenting or launching this. The Chinese central bank has already tried doing this with the digital yuan. And the question now for gold investors, at least, is whether or not this asset will pose a threat to gold as an alternative to financial instruments, traditional financial instruments.
It's fascinating, and I think it's very important. I would start by saying I'm no expert, nor is our firm at central bank digital currencies nor cryptocurrencies, but we've studied the process of gold going onto the blockchain a lot. And so in doing so, understand a little bit about what it takes. I think that your comments about China and now the ECB looking at digital currency are serious. And that they will, I think there's a lot of reasons why they will, and they would like to get into the digital currency issuance business, and that will probably be successful for them over time. I think that's probably going to be more an effective competitor against Bitcoin than it would against gold. Mm-hmm. But I do think that Bitcoin and gold can also coexist together because they're not controlled by central banks, and supply is more limited. So you've got the two of them on the digital side, I think, having a better chance against fiat currencies just because there's limited supply.
Yeah. And to your knowledge, do you know why the government, or if you were in the government, would you consider issuing instead gold-backed currency regimes?
Well, I don't think we need governments to do that. It would be great if governments could participate in digital gold issuance because they do use gold as a central reserve asset. But I do think that over the next year, and we've already seen 3 or 4 different gold token technologies exist and work. And I think that the various larger players in the gold market will be getting together and making sure that those are more of a commercial success going forward. So I do think you're going to see digital gold, on the blockchain emerge as a way to hold gold, and I think there's some very interesting advantages about that.
Okay, and finally, let's talk about Sprott's involvement with gold stocks now. You mentioned earlier that the sentiment index that Sprott tracks for gold sees gold as being relatively weak on the sentiment front. What about for gold stocks now, for the equity side? Is sentiment also weaker for stocks?
Yeah, so just to underscore that point, I don't think I've seen sentiment this week in like 20 years. So it really is an epic buying opportunity from that perspective.
But
For
why is it
gold
so weak
stocks,
right now? Why is it so weak? I mean, the gold price, yes, has fallen, but it's at 1730. It's still not historically very low right now, right?
no, that's right. Well, it's just had a very large pullback while other assets have relatively rallied. So you've got US stocks almost never being more overbought. So just relative to other assets, it is underperformed to that degree. So I would say on the side of gold stocks, many of them have corrected between 30 and 35%. I would just like to point out this is a very healthy industry right now at 1700, at 1800, at 1600. This is an industry that generates great margins, and the gold miners are very healthy. They're expanding, they're running tight ships now. And I would say they're going to impress on an earnings and cash flow side, which will increase their relative value compared to the rest of the S&P. So we think it's a table pounding buy opportunity on gold stocks.
Well, it's funny. I was speaking to analysts and economists last year during the bull run up to $2,000 an ounce, and even at those levels, people still said that gold mining companies were undervalued and there was more room to climb. It's had a pullback. I'm assuming you think it's still even more undervalued today, given this pullback, right?
Well, when gold stocks were running and gold was at 2,000, most investors and the professional community of analysts that follows gold stocks, and even the management teams, by and large, were using $1,600 gold prices to evaluate them. So nobody ever moved their numbers up to 2,000 anyway. Now that you've had this pullback, people haven't had to adjust their numbers down very much either. So you've just got, as you mentioned, 30% better value for stocks that are producing very healthy margins and earnings increases.
Okay. And would you say that margin deterioration over the last 6 months has been significant? Is this a major risk or challenge to you as an investor, or is it not so much?
Well, you had a couple of very high quarters in terms of cash generation, and now you're going to see quarters that have pulled back a bit. But year over year, and again, using long-term forecasts, no, you're still on the trend line where these companies are increasing their earnings and cash flows, and now they're much better value. So it's a very good industry to invest in now, and we see lots of value out there.
Okay, and finally, what do you think are the major challenges facing the mining company now? Last year, they had a fantastic year in terms of fundraising. This year, like you said, the fundamentals are still strong. So I'm just wondering if they're facing any additional challenges now.
Well, it's not fundraising. I think the difficulty is getting their operations to work to maximum efficiency, and a second challenge would be permitting, and both of those involve people, engineering, hard cost inputs, the environmental support, community support. Those are things that, given COVID, given the difficulties in raw material and engineering inputs, I know are stressing gold companies, is just making it all work logistically.
Which do you think has better value proposals right now, or proposition? Do you think the junior sector is more undervalued, or the seniors are?
Well, I'm of two minds there, okay? I'm sorry to sit on the fence on that one, but the seniors have pulled back more, and they're more supported by earnings and balance sheet. So if you're a classic stock investor, the big companies right now are a great opportunity. The juniors, I think you have to be more catalyst sensitive. You have to look for those that have a catalyst that will look or be taken over. And I do think that the majors will need to buy more reserve and fix the issue they have, which is lack of reserve growth. So I think there's going to be a lot more acquisitions in the sector.
Yeah, that was my follow-up. Do they need to buy reserves, or do they need to buy companies with reserves Is there
They need to buy, okay, so I'll be specific. They need to buy projects which meet their criteria, which for these big companies now, it's very tough to meet their criteria. So they need fantastic projects. And I think they need them as mineable as they could possibly be. So if possible, permitted and engineered to good specs. And those are hard to find.
You don't think they could engage in some greenfield exploration themselves?
Well, they are, especially around existing deposits. But I don't see any majors ripping on a huge exploration program greenfields. It's more around existing deposits and extending mine life. And
yeah, actually, I've spoken to some majors, the CEOs, and they generally. They've indicated that they would prefer to leave exploration to the juniors. Is that a sentiment that you share as an investor?
So there's some reasons for it. There's some reasons against it. You talk about governance. You talk about juniors mostly having one project, but it makes too much sense. And the bottom line is, doesn't matter what I think, it's happening. The majors would rather seed juniors and have a portfolio of projects that might work. It just makes too much sense. They can go so much faster, and they can pick the 1 out of 10 they really like. So I do think that's going to be a strategy that most seniors have.
Okay. And finally, the next 6 to 12 months, you mentioned gold could return to new all-time highs. Do you see more upside in the metal then, or gold stocks?
Well, if you get margins increasing by what, now the average ASIC margin is probably $600, $500, $600 an ounce. If you get margins doubling by having the gold price go up that much, you would think the gold stock should move roughly 2 to 3 times as much as the gold price. So I do think stocks outperform in that environment.
Okay, very good. Peter, thank you very much. Fantastic updates and insights.
Okay,
and
great.
I look forward to speaking with you again soon. Thank you for watching Kitco News. I'm David Lin.